So hello guys, we are going to discuss today inventory fundamentals. So we are into the financial accounting section and we are studying unit number 2. Okay, and topic is 2.2. 2.2 and 2.3, these two topics are relevant to inventory. So 2.2 we are going to start. This is called inventory. Like in this topic, we are going to talk about accounting aspects of inventory. Okay. And how to report the inventory in our financial statements. So here we go, starting with the definition of inventory. What is the inventory? Inventory actually is the total of tangible personal property. So keyword here is what? Tangible personal property. Tangible means it has physical existence, right? Personal property, sometimes obviously it is your own property and sometimes it is obviously movable also. So, and this inventory, whatever you are keeping with you, so this inventory we held for sale in the ordinary course of business. Held for sale means obviously it is available for sale. You are keeping this inventory for the sale purpose. In the ordinary course of business mean to say, like this is your routine business. For example, if you are running any business, maybe you are selling furniture or related items, and whatever furniture related items you are holding with the intention to resell, it will become your inventory. I'm using word here held for sale. I'm not saying held for use. Okay. Second point in the definition is in the inventory could be in the form of work in process. Work in process mean to say, sometime at the end of the period, you might have some units in the production line which are not yet completed, but still it is your inventory. Either it is in the shape of work in process, maybe it will be completed by the next year. And sometime you might have inventory in shape of finished goods also. And you might also have an inventory in shape of raw material itself if you are a manufacturing business. So this is what I'm saying. Inventory, it could be in the form of work in process to be completed and sold in ordinary course of the business. Or inventory could be in the form of, or it could be used up currently in producing goods or services for sale. Maybe like best example is raw material. Obviously, this raw material you will use in the production to sell it. Sometimes inventory could be consumable item also. Please remember inventory because it is always your current asset. Either it is, even it is a tangible, but it is your current asset. So inventory does not include long-term assets. Okay, with a subject to the depreciation. Like what does mean by long-term asset? Sometimes you might have property, plant and equipment, okay, which are subject to the depreciation. And obviously we depreciate only those assets which we are using in our business. We are not keeping those assets for sale in ordinary course of business. But so this is the point you have to remember. Sometimes we might have long-term assets held for sale also. But what is the point? The long-term assets either subject to depreciation, obviously those assets are subject to depreciation which we are using, right? Or retired from regular use, like maybe assets are retired, previously you were using, now it is retired and held for sale. Retired assets are held for sale, are not classified as inventory because it is not your ordinary course of business. Okay, so mostly you have to remember these 3 points for the definition of inventory. Understood? So here we go. Now we have some extra discussion. Obviously, we have 2 types of businesses. The first type of business is called retailers or wholesalers. Please switch off your mics. First, we have here retailers and wholesaler. Obviously, retailers and wholesaler, obviously, these are those parties who buy the product with the intention to resell without any significant modification. They sell their product. Okay, this is what is called retailer or wholesaler. So we were talking about, we have two types of businesses. One is called retailers or wholesaler. And second, we have what? Manufacturer. What I told you about retailers. Retailers mean to say like these are those businesses which would buy the product with the intention to resell. And obviously they are not the manufacturer. So they buy the ready-made product and sell as it without significant modification. Like they don't modify the products much, right? Maybe they can change the packing, things like that, but without significant modifications or substantial modifications, we are selling. So those businesses are called what? Retail businesses. There are a couple of examples, obviously, the outlet, the Lulu Center, Carrefour, right, in UAE. So these are also the retailers, mostly. They might also have some products which they are manufacturing, but mostly their nature of business is retail type of businesses. You might have so many mobile outlets which they buy a ready-made product from Apple, from Samsung, right, and sell as it. So those businesses are called what? Retailers. Guys, remember, for retailers, inventory is always in shape of finished goods. In shape of finished goods means ready goods, right? On the other hand, we have other type of business which is called manufacturer. Manufacturing companies are those companies, obviously, which would buy raw material first, right? Then they will inject this raw material to the production line. Then they will work on that, and then they will convert this product into the finished goods. So for manufacturing, we might have inventory in three shapes. It could be in shape of raw material. Maybe you have some raw material at the end of the period, which is unused, not yet used. So you might have inventory in shape of work in process or work in progress. It means like you might have some items still in the production line, which are not yet completed by the end of the period, right? Maybe it will be completed in the next accounting period. So those goods are called work in progress. So you might have some goods in the production line by the end of the year also. And third shape, you might have some goods in shape of finished goods also. For example, Toyota Corporation, they might have some cars as a ready product, but these cars are not yet sold. These are unsold with them. So this is what is called your manufacturing type of businesses, right? Now here, the main point I'm going to start now after the basic kind of introduction, 2-3 definitions. Just we discussed like what is the inventory. We discussed about what is the retailer definition and what is the manufacturer. Now we are going to talk about, guys, cost basis of inventory. Okay, so we will go through this topic, and this especially it is called initial measurement. What does mean by initial measurement? Initial measurement means to say when you buy the inventory, right? And you want to record obviously into your books of accounts. So at which value you will record? At which value? Like what should be the value in dollar or in pound? Okay, so that is called measurement. So to get the measurement idea, so we have one definition. Every point which will fit into this definition will be the part of that measurement. Okay, please remember, guys, when initially we measure the inventory, we always measure the inventory at cost. What is the word? At cost. Now we need to understand this word. What does mean by cost? Okay, initially you will record inventory at cost. So what will include, what will be the part of cost? Here we have a definition for that. What is the definition? The cost of inventory includes all costs incurred in bringing the inventories to their existing location and ready to use condition. Let me give you example here. There are two keywords. All the cost which you will incur to bring the inventory to present location. This is the first word. And second is what? Ready to use condition. Present location means what? For example, you are buying raw material from USA. You are living in UAE. Okay, you are doing your business in UAE. So you are buying raw material from USA. Now all the cost which you will incur to bring the inventory to UAE location, right, to your business location, this will be the part of cost. So we have a couple of examples. Detail I will discuss with the table. For example, you might pay the purchase price first to the supplier. That will be the part of cost. Then you might incur some transportation in cost, freight in cost to bring this. You might pay some custom duties, some non-refundable taxes. So you might have an insurance also maybe. So these costs will be the part of what? Inventory cost. Second keyword is what? Ready to use condition. So obviously, if it is a raw material and maybe it is a wood, assume, but you want to manufacture maybe furniture items. So ready to use condition is what? You will bring the raw material to the present location. Then you will incur some labor cost on this wood, some other overhead costs like electricity, etc. You are also paying rent of the facilities where the production is going on. So all these costs will also be the part of inventory cost. Right? So these are just two keywords I have explained. Now let's go through case by case. So here we go. There are two scenarios. Because we are talking about cost of inventory, right? Cost of inventory. There are two scenarios. What if you are purchasing the inventory? That is called cost of purchased inventory. Then which items will be the part of cost? Second scenario is what? How to calculate the cost of manufactured inventory, right? If you are a manufacturing business. So starting from here, so we are talking about cost of purchased inventory. It could be a finished goods, it could be a raw material which you are buying, right? So what it will include? So this is the list which you should remember in your mind. You have to memorize in order to solve theoretical questions. Number one, you have to add a purchase price. Purchase price means the list price, mostly the tag price. Mostly this price, obviously, you will pay to the supplier, right? That you will take. Then you will deduct from there what? Trade discount. Sometimes, you know, the supplier might offer you discount in the list price, right or wrong? That discount you have to subtract. Then you have to deduct what? Return, I mean, say purchase returns and allowances. Maybe you have some purchase returns also. So you will deduct from here. Then guys, you will add what? Transportation in cost. Because this cost you are going to incur to bring the inventory. Then you have to add here what? Non-refundable taxes, not the refundable. If you paid some kind of VAT, value added tax, which is refundable, that is not going to be added here. You have to add here any tax which is non-refundable. You have to look the word non-refundable. Okay, this tax, because it is not going to be reimbursed to you, so obviously it is your cost. Then what extra item you might have? You might have what? Insurance cost also, okay, during transit. So you might have what? Handling cost also, that you will also add. Handling cost means a loading or unloading type of cost. And then you might have any other cost which is necessary to bring the inventory to the present location. Right? If you will add all, so this, I would say it is called your net purchases. What it is called? Net purchases. Okay, the cost of purchased inventory. Understood? Now we are going to talk about cost of manufactured inventory. If you are a manufacturer, so what will be the part of cost of inventory? Please guys, you have to remember this equation, short equation. We will extend it after a few minutes also. So, but what is the short equation to get the cost of manufactured inventory? So you have to take care, because here you might have inventory in shape of raw material also, right or wrong? And for raw material, what cost you will take it to the manufacturing area, that should be the cost of material used, not the cost of material purchased. What I'm saying, for example, if you are manufacturing the chairs, so how much material you have used in the production of chairs, that should be taken, not the material which you have purchased. Maybe you purchased more, but you have used less. So you have to take cost of material used to reach to this value, to the cost of material used. We need to go through this equation. Actually, we need cost of material used, but how to reach to this value? So first of all, you have to take what? Cost of opening raw material. You don't need to estimate. It will be provided in the question. Just you need to take it out from the question. You have to take cost of opening raw material. He will provide in the question, like at the start of the period, this was the cost of the raw material, whatever you are keeping, right? You will add there cost of net purchasing. Actually, I told you net purchasing, how to got it. Right or wrong, you will take from the purchase price till the handling cost, you will add. Okay, this is your net purchases, you will add it here. Right? Because material, once you will buy, obviously you might incur all these costs. Clear? Then what you will do, then you have to deduct from here. What do you have to deduct? Cost of closing raw material. You don't need to calculate, it will be given in the question. So once you will deduct that value, so this is called what? Cost of material used in the production which we need. Got it? After that, what you will do? Obviously, once you got a material cost, then you have to add conversion cost. Which cost? Conversion. Conversion cost means to say the cost. It's by definition I'm explaining. These are those costs which we will incur to convert the material into finished goods. Right or wrong? So what cost it might include? It might include obviously labor cost, and it might include what? Cost of overheads. Overheads we will see in detail in costing, but I can just give you example, like we obviously incur the cost other than material and labor also to manufacture the product, like electricity, rent, depreciation of plant and machinery which you are using, insurance of those plant and machinery, right or wrong, maybe you have some gas expenses kind of things. So all these are called your overheads. Okay, so you will add those costs. So then guys, from this is what is called your total manufacturing cost. Please remember, this is not the complete format. Complete format I'm going to explain with the calculation of cost of goods sold, right? Because here we need to include also work in process data as well. If you have opening work in process and closing work in process, this was just the overview which I have given you. Okay, so now we are moving, because this inventory is the part of income statement also, right or wrong, and it is the part of balance sheet as well. And this inventory, closing inventory especially, okay, you will also write under cost of goods sold, not only closing, opening inventory as well. You are including in the cost of goods sold calculation under income statement, right? And it is going to be part of your current asset also in the balance sheet, right? So this is what we are. First, we are going to talk about what? Cost of goods sold. Okay, how the cost of goods sold is calculated for retailers and for manufacturers. And from here, question could be tested calculation wise. Radical wise, he might ask you which cost will be the part of inventory, which will not be the part of inventory, right? That I'm going to cover also with the help of cost of goods sold format. Clear? So here from cost of goods sold, plenty of questions could be asked. So I will tell you how to answer those questions. So just you need to first memorize the format of cost of goods sold, because that format we can reverse in exam questions also. to find out missing data. Okay, so here we go. Cost of goods sold calculations we are going to discuss now. Please note, this is a really important note, because I said in inventory should be recorded initially at cost, and I told you what components will be the part of cost. Please note, these components will not be the part of cost of inventory. Which components? Number one, storage cost. Don't include in the cost of inventory, because this cost is not necessary to bring the asset to the present location or to ready to use condition. Then guys, you will also not include what? Selling cost, because it is not necessary to bring the asset to the present location or to the ready to use condition. Actually, these costs are necessary to sell the product, like marketing cost. And please also note administration cost, like maybe you have administration department, right? Like accounts department, HR department, maybe other administration department. Their cost will also be not the part of inventory. These are our other expenses. Okay, 3 words. What is it? Storage cost, selling cost, and administration cost. If you have any refundable taxes, that should also be not the part of cost of inventory. Right? Clear? So now we are going to talk about cost of goods sold format. And this format you need to memorize.
But sir, I mean, at certain times we are bringing goods from other country and we are storing it in a warehouse until it's getting clear documentation.
No, they're not that storage, or you should not include actually.
No, but that will be a part of the cost, I mean, because we will be paying it to the clearing agent.
Now, if you are paying, if it is the part of that, if you feel it is necessary to bring, then maybe you have like storage cost, maybe your inventory is at the custom, maybe.
Exactly.
Maybe if you are paying some cost, then you can add. But in your normal warehouse where you are keeping inventory, that storage cost should not be there. Okay. So as I told you, this definition you have to keep in your mind, all the costs which are necessary to bring the inventory to the present location or to the ready to use condition. That could be the part. Okay. Whatever will fit in this definition, that can be the part of cost of inventory. Okay. If it is your normal warehouse facility where maybe inventory is waiting to release for the production process, that should not be the part. Okay. Then guys, here we are aware how to calculate cost of goods sold. First, we are talking about what? Retailers. Right? And obviously I told you retailers, they have inventory in shape of what? Finished goods. Correct? So here we go, how to get that cost of goods sold. First of all, you have to take beginning inventory of finished goods. It will be given in the question. Then you will add here. I would say these 2 lines is your net purchases. Okay, like purchases minus purchase return plus freight in whatever. So you will add net purchases into that. See, once you will take beginning inventory plus net purchases, this is known as cost of goods available for sale. Correct? Then you will deduct from here what? Minus ending inventory. Here ending inventory means say unsold inventory, which you have at the end of the period. So the remaining will give you what? The cost of goods sold. Now see, equation is very easy, but you have to reverse sometime also. For example, if you are required to calculate this cost of goods available for sale in the question. So now there could be 2 ways. And you have to identify from the question which data is available. Which 2 ways are there? First could be a straightaway ways. First way, like you have to take what? Beginning inventory plus what? Net purchases is equal to cost of goods available for sale. Or you might go reverse from there to this value. And whenever you go reverse, plus sign will become minus and minus will become plus. Right? So here you will take, if you are going reverse, you will take on your calculator cost of goods sold, and then you will add back what closing inventory you can reach to the cost of goods sold. Right? For example, I'm assuming here now all other data is available. For example, maybe from this question, you are going to calculate what value of beginning inventory. Maybe you are provided with the cost of goods sold, you are provided with the ending inventory, and you are provided with the net purchases. And how to get the opening inventory? Obviously, you have to go reverse, right or wrong? And on your calculator, first of all, you will take what? Cost of goods sold. Then you will plus here what? Ending inventory. And this was plus. You will deduct now net purchases. You will automatically reach to the beginning inventory. Right? Clear? If you are calculating the last point, then you have to go straight. You have to come straight. Like plus will remain plus and minus will remain minus. But if you have to calculate any point of these, maybe you have to calculate beginning inventory, purchases value, or what? Ending inventory. So you have to go reverse. Understood? This equation you need to memorize, please. Now this is how it will work for the retailers. But now we are going to talk about for manufacturers. Okay, for manufacturer. Obviously, manufacturer will have inventory in three shapes. They might have inventory in shape of raw material. Second, they might have a shape in shape of work in progress or process. Third, they might have inventory in shape of what? Finished goods. And we are working with what? Cost of goods sold. You studied this in your earlier studies also, but just we are going to recap quickly. So first we will deal with the raw material. And this I already told you. For the raw material, what you will do? You will start first item. You will take what? Beginning raw material inventory. Whatever value is given in the question, you will use that. And then you will add what? Net purchases during the period, you will add. Then you will deduct ending direct material inventory, you will deduct. So this will give you what? Raw material used in the production. This is what we need actually. Understood? For example, I'm assuming this value is given, this value is given, this value is given. And you are required to calculate this value. And what is this value? Ending material inventory. Can you calculate? Yes, because you have to go reverse now. Now you will go reverse. On your calculator, you will take first raw material used. Then you will deduct what? Purchases. And then you will deduct what? Opening. Automatically on your calculator, you will get what? Ending raw material inventory. Understood? Continues. With every possibility, you have to be aware with all possibilities. Right? Now, once you got this value, what value you got? Raw material used in production. Now we will add here conversion cost. Which cost? Conversions. And conversion cost will include what? Cost of direct labor. Plus it will include what? Cost of overhead cost. All overheads, either those are fixed or variable. So you will add that also. So this is going to give you what? Total manufacturing cost. If you remember, till here I already explained previously also. Right? Now ready for question? I'm going to ask question. In fact, I will explain. For example, guys, now in your exam question, he is asking you to calculate this value, for example. What is this value? Raw material used in production. Now there are two ways. First, you can come from top to bottom, or you can go back from this value to this also. Right or wrong? Top to bottom once you are moving. So you will take opening inventory of raw material plus purchases less ending inventory. So you will get raw material used. But if you are moving from this value from bottom to up, so you are going reverse. Right? You will take on your calculator total manufacturing cost. Then you will deduct here overhead cost. You will also deduct what? Labor cost. You will reach to this value. Right? So because you have to be very careful in your exam question, because you need to look in which direction you have to move. It's coming straight or you have to go reverse. Understood? So we reached to the which value so far? We reached to total manufacturing cost. Now guys, what you will do here, you are going to adjust work in process, this area. These values will be given. Okay, so you will add here, add what? Beginning work in process inventory. And you will deduct here what? Ending work in process inventory. And this will give you now what? Cost of goods manufactured. These are those goods which are completed in this year. And this is their cost. Understood? Now maybe you're thinking how practically we will get the value for work in process. So we can use different costing methods. Ideally, we are using most of the time process costing. There is a technique which we will cover under costing section. So process costing most of the time we are using, right, to calculate the value for work in process. But in terms of accounting, it will be given. In terms of costing, you have to calculate. Clear? Now, guys, obviously, again, I'm asking question. For example, I'm asking you now, you have to calculate this cost. Which cost? Total manufacturing cost. Again, there could be two possible ways. First way, you can come from this to this, or you can go from this value to this value. Right or wrong? If you're coming from top to bottom, so you have to take first direct raw material used plus labor cost plus overhead cost. Right? If you're going reverse, you have to take on your calculator what? Cost of goods manufactured. Then you have to add what? Ending work in process value. And then you will deduct what? Beginning work in process, because you are going reverse. When you go reverse, plus will become minus and minus will become plus. Understood? All possibilities, without possibility, you have to be aware. Now guys, after that, this area, here we are going to adjust what? Finished goods. And this area was about what? Work in process. And this area was about what? Raw material. Now you are dealing with the finished goods. So you reach to this value already. Cost of goods manufactured. Now what you will do, you will add there beginning value, beginning inventory of finished goods. Right? And there you can add one more line. Once you will take this value, which is cost of goods manufactured, plus this value, which is value of beginning inventory of finished goods. So this is known as cost of goods available for sale. Cost of goods available for sale, but it's not written in the format, but it is called cost of goods available for sale. Then you will deduct from here what? Ending finished goods inventory, and you will reach to what? Cost of goods sold. I hope so the format is clear. Got it? Now guys, this is just small because first we are moving to the main things, but by studying different portions of the accounting. So far we have done what is the definition of inventory. We have done what is the retail businesses, what is the manufacturing business, and we are also done how to get the cost of goods sold for retailers, the cost of goods sold for manufacturer. And now we are moving forward. There is another small independent topic relevant to the inventory. This is called what? Inventory accounting system. Actually, we have two accounting systems which we can use for the inventory purpose. Okay. The first system is called what? Perpetual inventory system. And the second system for accounting, that is called what? Periodic inventory system. Practically it's important. Calculation I will also explain, don't you worry. Whatever is required at this level. Okay, so perpetual. Perpetual, starting with the perpetual first. Perpetual mean to say continuous updating inventory system. Like here, what are the points? These points you need to keep in your mind in order to answer theoretical questions. Point number one, under perpetual inventory system, what we will do, we will update inventory accounts or inventory records after each purchase or sale, because it is continuous system. After every purchase you have to record, and after every sale you have to record, right? Then guys, point number 2, this system is more suitable if you are dealing with what? Expensive product and what? Heterogeneous product. Like for example, you're dealing with the cars, right? You are working with Alpotane, you are the accountant there or inventory controller there. So you have different cars, items are expensive and also heterogeneous, right? Because different types of cars are there. And if you will misplace maybe one item, right or wrong, so there could be a problem. So if you are dealing with the diamonds, that is also expensive item, that is small in scale, in size. If you will lose one, maybe it will cost you a huge amount, right or wrong? So this is what is called heterogeneous items, right? So 2 points we are done. Point number 3. Here what you will do, purchases and other items related to the inventory. Costing are charged directly to the inventory. What it means here? It means whenever you will buy the product. So we will not use the word here purchases. We will use the word inventory, like debit inventory or credit inventory, right? We will use the word inventory, right? And next point is what? Whenever you will sell the item. So you will always pass 2 entries under perpetual system. Practically, maybe 1 entry is required, second entry system is passing automatically in the backend. But if you are working manually, so you have to pass 2 entries. First entry you have to pass with the sale price. And mostly what entry we pass? Debit, receivables or cash. Credit what? Revenue with the sale price. And second inventory, you have to, second entry, you will pass to adjust cost of goods sold and what? Inventory. What entry you will pass? You will debit the cost of goods sold and you will credit the inventory, because inventory is sold. You have to remove and it should be the part of cost of goods sold. So 2 entries are required. Entries I will show you with the example, don't you worry. But how many entries are required? 2. Right? So what is the advantage of perpetual system if you are using? Advantage is what? Here what will happen? The amount of inventory which is showing in the record and the inventory which you will have physically, obviously it should match, because every entry, every transaction is recorded into the system, right or wrong? So this should match. Now what is the disadvantage of this system? The disadvantage of the perpetual inventory system is that the bookkeeping is more complex and expensive, obviously, because it requires continuous monitoring, right or wrong? It will increase your work. Clear? So then we have a second system which is called what? Periodic system. It is a bit opposite. And please remember one more point regarding perpetual. One point I missed that I'm going to explain. Like if you want to get cost of goods sold under perpetual system, you can get on a single click from your system, because every sale is recorded with the sale price also and with the cost of goods sold also. But under periodic system, it is not going to happen. Under periodic system, you cannot get cost of goods sold from your system. You have to calculate at the end of certain period. Okay, and how you will get it, that I will show you. Okay, so here what is the differences now between periodic and perpetual? Please remember difference number 1. Here, inventory and cost of goods sold are updated at specific interval at the end of certain time period. But under perpetual, after each purchase and sale, every transaction. But here no, right? At the end of specific period, you will update. Then guys, what we have here, obviously here physical count is more important under periodic, because you will record every sale, but with every sale you don't record cost of goods sold and inventory under periodic. That is why physical count of inventory is more important. Mostly whatever inventory is showing, in your financial statement that is based on physical count, not based on system values only. Right? Because physical count is more important there. Then second point is what? Second difference is what is this system is very good if you are using for, or if you are dealing with inexpensive product, cheaper product. For example, you are selling tea, coffee, maybe $2 things, $3 things, then it is not necessary for each sale. You have to record cost of goods sold and inventory also. Right? So it is better for inexpensive and homogeneous product, which are almost similar product. Then guys, here, point number 3 is what? Whenever you will buy inventory, you will not use the word debit inventory or credit inventory. You will use the word purchases here. Debit purchases or credit purchases. Okay, but under perpetual, what we were doing? We were using the word inventory itself. Then you will use the word purchases. Okay, this is just a difference I'm explaining. Then guys, here point number 4. Point number 4 is what? Beginning. Okay, this I will explain actually with the help of cost of goods sold calculation just now, but because it will be more suitable there. And the last point is what? Changes in inventory and the cost of goods sold are recorded only when at the end of the period based on physical count. As I told you, physical count is more important. This point I will explain now with the help of example. Okay, how to get cost of goods sold and how to close purchases account, opening inventory account to get the value for cost of goods sold. Point number 4. I will explain with the help of examples. Here we go, guys. So let's go through small example. First, I would request you just read this data from here till here. Just go through, guys, quickly, please. Okay, guys. So here we have a small example now. I hope so you have gone through. So here we have some data in the beginning inventory. How much? 1,000 units, and these units were purchased at $5 each. Then during the year, you have few transactions. April 1 and what? May 1. Here we have sold how many units? 600 units with the price of 4,800. Obviously, these units are sold from 1,000 units if you are using first in, first out method. And then you have a purchases. You have purchased 250 inventory units for $5 each per unit. This is the data, and let's assume you are using first perpetual system. Right? If you're using perpetual system, because every sale is recorded in the system. With every sale, you will also record cost of goods sold and inventory as well. So what are the relevant entries? So first of all, you have purchased on April 1. Right? You have sold. And you sold for how much? 4,800. And obviously you sold from which units? From the opening inventory, 1,000 units. So you have sold 600 units. You sold for how much? 4,800. So you will record first debit, cash, credit, sale by with the sale price. Understood? Then obviously when you will sell any item, you have to record corresponding cost of goods sold and inventory also. And what was the cost per unit? 5 per unit, which you sold. And how many units you sold? 600. Because you sold from opening inventory. So 600 times 5. It is going to give you 3,000. So you have to record cost. What entry you will pass? Debit cost of goods sold with 3,000 and credit what? Inventory with 3,000. Understood? Then you have purchased inventory. How many units? 250 units with the price of $5 each. So what you will do? You will debit the inventory. Instead of purchases, you will use the word inventory and credit the cash. 250 units are there for $5 each. You bought it. So total is going to be 1250. 1250. Right? And at the end of, obviously, if you want cost of goods sold, idea is very simple because you are maintaining your proper records. So cost of goods sold can be calculated by using this way. We can take opening inventory plus what? Purchases less what? Ending inventory, right? Is equal to what? Cost of goods sold. Shortcut I'm explaining. Opening inventory, how many units you have? 1,000 at $5. So it will give you how much?
Right.
5,000 plus purchases you have 250 units at 5 each. It is 1250. Ending inventory I don't know. We can calculate, but cost of goods sold I know, which is 3,000. We have passed the entry here with 3,000. Right? So it means automatically the difference, whatever maybe it will be 3,250. I'm not sure. Just check on your calculator. This is going to be your ending inventory as a balancing value, right? Understood? How you got this 3,250? Take cost of goods sold, deduct purchases, deduct opening inventory. Automatically on your calculator, you will get negative value of ending inventory. Clear? Understood? Otherwise, this ending inventory value can be calculated by using FIFO method, LIFO method, average methods, which we will discuss in upcoming session, not today. Clear? Now, we are going to deal with which system now? Periodic system. Periodic. Obviously, whenever you will sell the item, so you have to record the sale. Okay, so what entry you will pass? Debit, cash, credit, sale, same entry here. But we will not record cost of goods sold here, because cost of goods sold and ending inventory on physical count we can calculate at the end of the period. Now you will get, I will tell you, don't you worry. Then you have a purchases, right? Then you have a purchases. Here you use the word, which word? Debit, inventory, credit, cash. But here we are using the word debit, purchases, credit, cash value is the same. But guys, please remember here now what I'm going to explain to you, how to get cost of goods sold here. Here cost of goods sold will be calculated as a balancing value. Which value? Balancing value at the end of the period. So how it is going to work? Let me just use a pen here. This entry is written. This entry I'm going to explain how we got it. So at the end of the specific period, guys, what do you have to do? You have to do these things. Number one, you have to close. I'm using word close purchases account. Right? You know, normally purchases account is debit. If you want to close it, what do you have to do? You have to credit the value. Right or wrong? Second is what? You also need to transfer the opening inventory. Opening inventory to the cost of goods sold. Normally inventory is debit. Right or wrong? So here what we will do? We will credit. And then third thing what you have to do? You have to record. Record which inventory? Closing inventory. You have to record like what is the closing inventory at the end of the period. Because if you have to record closing inventory, you are not going to close. You are going to record. So closing inventory is your asset. It will be a debit. Once you will do these things, debit and credit. Debit and credit. Obviously, the both thing, the balancing thing will be your cost of goods sold. How? Let's pass the entry now. So first we have to record closing inventory. So you have to debit closing inventory. Okay. Then what? You have to credit what, guys? Opening inventory. And opening inventory value, you know, 1,000 units are there times 5. It is going to be 3,000. Then you also need to close which account? Purchases account. So we will credit the purchases account also. Okay. Purchases account. How many units you purchased? 250 at the each $5, 1250. And automatically you can see closing inventory. As I told you, practically you will get through FIFO, LIFO weighted average. Okay, for example, it is how much? 3,250. Assume. Right? Now, obviously, the balancing figure, because this closing inventory I'm taking as we have calculated in the perpetual system. Same value I'm using this thing. Right? Then, guys, the difference is coming on debit side. You would see here 3,000. This difference is going to be your cost of goods sold as a balancing value. Clear? Got it? So here you can get the cost of goods sold as a balancing value. How much it is going to be? This was actually the 5,000 or 3. Right? Understood? So 3,000 is going to be a cost of goods sold. So it means Under the periodic system, what do you have to do? You will close purchases account. You will close opening inventory account. You will create closing inventory. And the difference, the result would be what your cost of goods sold. Got it? Understood? Correct. And under periodic system, physical count is very important. And mostly closing inventory value, it is based on physical count. Right? Clear? Here we go. I hope so it is clear, guys. Please confirm through the chat option if they're clear. Now we are going to talk about inventory, period, and what? Physical count. Actually, what is the idea here? Sometimes there are certain terminologies are there relevant to the shippings and relevant to the consignment. Right? So, for example, let me give you example. Maybe simply we are discussing here what actually the topic we are going to discuss here. For example, your supplier is sitting in USA and you are living in, for example, UAE. Here you have a supplier and here we are a customer. We are buying the item from US. So now, guys, obviously they are using ship. Let's zoom in through the sea. They are just supplying the items. And in between we have a sea, obviously, right? And in sea, our goods are on the boat, for example. And now there is a year end. Year end. Goods are not with the supplier. It is not with the customer. It is with the shipping company. And now there is a year end. And there is a problem. Problem is what? Who should say it is my inventory? Supplier or customer? For that, we have to understand two terminologies. One is called FOB shipment point, shipping point, FOB shipping point. This is one kind of agreement. Okay. And then you have a second terminologies. Okay, that is called FOB destination. FOB stands for free on board. Actually, it is not free. You have to pay. It's just a shipping word. Huh? So FOB shipping point, if in this you are into this agreement, there are slightly different rules for customer and supplier. And if you are under FOB destination rule, there is a slight difference. So these goods which are not with the supplier, not with the customer, these are called goods in transit. Goods in transit. Okay, so it means here we have to study first FOB shipping point and FOB destination, which will affect your physical count. Right? The third the terminology which we need to understand, that is consignment. This is the third terminology. What is the consignment? Let me just quickly brief you and then we will move it to the main topic. Consignment is what? Like our inventory which is held by third party. For example, just giving example, let's assume we have a Samsung company. Samsung company, they are placing their mobiles, for example, with Sharaf DG, let's assume, just assuming, on sale and return basis. I'm assuming, I'm not sure Sharaf DG is buying the product or Samsung just they are placing the product. But I am assuming here, Samsung is placing their product at their outlet, right? And what Sharaf DG is getting, they are getting commission for each sale. Now it means, for example, maybe Samsung company has provided, let's assume 100 mobile phones to the Sharaf DG. And out of this 100, for example, 80 mobile phones are sold. How many mobiles are unsold? 20 mobiles are what? Unsold. But these 20 mobiles is the inventory of Samsung, not the Sharaf DG, right or wrong? In this transaction, Samsung will be considered as consignor, and the Sharaf DG will be considered as what? Consigning. And this inventory, the 20 units unsold, is of the consignors. consignors, not the consignee. Okay, got it? And inventory you record at sale price or at cost? Cost. So that is where you have to pick 20 items, multiply by their cost. Don't multiply with their sale price. Understood? So let's understand these three terminologies and we will go through this now, guys. Please remember here, physical count. Let me tell you the importance of physical count. Then I will move to those three terminologies. Physical count is really, really important. The reason, sometime in my record, inventory might be more. But in physical, we might have a less inventory. Right or wrong? Why? There could be a theft of inventory also. Theft of inventory. Plus physical count will help you to identify what? The misstatement in the records as well. For example, in system it's showing less or it's showing more. But physically it could be less or more. Simply it's different than system. So maybe there's a problem with the system. Maybe some transactions are not updated in the system. That is why it's different. Right or wrong? So physical count will help you in two different ways. To correct or to identify the misstatement in the records and what? To identify the theft of inventory. Okay. So guys, here we go. So starting with goods in transit. I need your concentration here. I will use different angles to explain, please. You have to understand what I'm saying. So first I'm talking about goods in transit case. Goods in transit means it's not with supplier, nor with supplier, a customer. It's in between. And who would claim this is my inventory? Customer or supplier? I told you there are two different types of contract. There could be more, but in our syllabus too. One is called what? FOB, shipping point. And second is what? FOB, destination. In order to understand these two words, you have to focus on keyword. What is the keyword? Keyword is when the risk of ownership or when the risk or rewards of the ownership is transferred to the customer. Right? Risk and reward. Risk and reward, you understand? Risk and reward means if something will happen with the inventory, maybe it's going to be damaged or maybe its price will increase, both risk and reward. When this is going to be transferred? Obviously, the point at which risk and rewards are transferred to the customer. It means seller is no more responsible. It is whose inventory? Customer inventory. And now risk and rewards are transferred at two different places. Under FOB shipping point. Under FOB shipping point. Risk and rewards of the inventory will be transferred to the customer once the supplier will hand over the goods to the shipping company. To the shipping company only. Not to the customer. Once the supplier will hand over to the shipping company, good risk and rewards are transferred under this agreement. It means even these goods are in transit at the end of year, it is the inventory of customer. Understood? It's reached or not reached doesn't matter. The matter is when risk and reward is transferred. And risk and rewards are transferred at the time of shipment. When the supplier will deliver the goods to the shipping company. Right? Here, what is important? Here, shipping date is important. What is important? Shipping date. If shipping date falls before year end, even goods are not received by customer. If shipping date falls before the year end, obviously it's the customer inventory. And by the end of year, customer will add this inventory in his physical count. But for you guys, it's not matters as simple as it looks. No. For you guys, you have to identify from the question first, are you a seller or a customer? First, you have to identify your position. Then you have to apply this rule. Maybe in question he says you are seller. You are supplying the items and goods are handed over to the shipping company on 29th December. That's it. It's not your inventory because risk and rewards are transferred to the customer at the point of shipment. So it's a customer inventory, you will not take it in your physical count. But if you are a customer, obviously it is your inventory. Right? So you have to identify first your position from the question. Are you a customer or you a supplier? This is the first thing which needs to be decided. Secondary thing is the shipping date then. Okay. Now we have here what? FOB destination. Here shipment date is totally irrelevant. Here receiving date is important. When customer is going to receive. That is called destination. For example, supplier is selling in USA, customer is selling in UAE, and here supplier under this agreement, supplier is saying, I am taking your responsibility of goods until it will reach to your doorstep. The day when you will take the goods, it is yours. Otherwise, I am responsible. Under destination, what is the important thing? Receiving date. Right? That is important. Okay, now I'm asking you, for example, goods are shipped. This destination I'm explaining, destination. I'm saying goods are shipped on 29th December, but received by customer, on 5th January of next year. It means at the end of the year it was in transit. Who would say it's my inventory, supplier or customer? It's a destination. Receiving date is important. It's supplier's inventory, not the customer inventory, because goods have not reached to the customer. It's supplier inventory. What supplier will do? He will add back this inventory in his physical count. Why he will add back? Because at the time of shipment he removed. Now he need to add back because it's not reached. But if goods reached to the customer before year end, then there is no matter. It's not in transit. You received already. It's customer inventory. Understood? So point is what? When risk and rewards are going to be transferred. In the shipment point, risk and rewards will be transferred at the time of shipment. In destination point, risk and rewards will be transferred at the destination. And you have to identify your position first on the question of you are a customer or supplier. Then accordingly you will take decision. I will do questions with you, don't you worry. Okay. And the third point, I told you for what? Consignment. Okay. Theory is written here. You can go through. Okay. So you can go through this. It's explained here. Now I'm talking about the consignment. Consignment is what I told you, very simple. With the help of example, like Samsung as a company, they have placed some inventory with the Sharaf PG, right? And there could be some quantity of inventory which is held by Sharaf DG. In simple words, that inventory is not sold, but it belongs to what? To Samsung. At the end of the year, Samsung will take into account. They will count this inventory as their own inventory. Right or wrong? But it should be recorded at what? Cost. It means in question what you have to do. First of all, you have to identify your position, or you are a consigner or a consignee, because inventory belongs to consigner, not to the consignor. If you are a consigner, then you have to, second thing you have to identify, how much is the inventory which is unsold, not sold, unsold. And third thing which you have to decide, what is the cost of that inventory, not the sale price. Once you will take unsold inventory times cost of that inventory, you will get the total cost of unsold inventory. This you will add in the consignor's book. Clear? Ready for question? So here we go. We have example here. First of all, I would request you take time and read these two statements, only these two, because one by one we will adjust. First, read it, please. You read it? I hope you have gone through. I will not read the statements, but I will explain the solution here. That's first of all, they are saying without considering this information, without adjustment of these in points. So we have inventory value of how much? 50,000. And please don't forget you are entity A here, not a B, entity A. Okay. So I will take this 50,000, I will write it here first. Because this 50,000 I need to adjust. I have to do some plus minus into this value. So what is the point number one? In this point, what's written, they're saying during the year. Entity A consigned goods with a total cost to entity B. And please don't forget, we are consignor here. It is our inventory. So what the points I told you, you have to identify your position. You have identified here, you are consignor. Second thing, you need to identify unsold inventory by consignee or held by consignee. Okay, so unsold inventory we need to identify, and then we need to take their cost. Right or wrong? So then they're saying that the annual statement that was sent from entity B to A states that 60% of consignment goods were sold. What is unsold proportionate? 40%. Right? So you will take 40% of cost, and cost was how much? 60,000. I will say it is going to be 24,000. Right? Because you have to take cost. I told you identify your position, you are consignor. Identify the unsold percentage, which is 40%, and take at their cost. Cost is 60,000. Right? We will take 40% of 60, you will add here 24,000. You will add into 50,000. Clear? Understood? I hope it is clear. Then guys, point number 3. Go through this point, please. First, go through. Second point I need to see. Read it? Here we go. So merchandise means goods costing 40,000 and inventory is recorded at cost. Don't forget. FOB shipping point. It's a shipping point. It means risk and rewards will be transferred from supplier to customer at the time of shipment. Right? From a vendor. It means what you are here. You are a customer here. Okay. Now on December 29, year 1, this is the shipping date, and was received by you on January 4, year 2. Receiving date is not important. Shipment date is important. So shipment date is what? 29 December, and supplier has a handover to the shipping company. It means it's our inventory because we are customer here. It means this inventory should be added into our inventory. And what is the cost? 40. So I will add here 40,000 more. Understood? Now we have a next one more point. Read this, please. Next point, point number 3. So in this point, merchandise costing 70,000. Shipped FOB destination from a vendor. So we are customer here. And receiving date is important. Check when we received. We are customer here. It is shipped on 30th December, but was received on 5th January. It means at the end of year we didn't receive. It is not our inventory. Because risk and rewards are not transferred to us. Right or wrong? So it means we will not take into account. So simply ignore this. Simply ignore this because it is a supplier inventory and we are not a supplier here. We are a customer here. Right? So ignore this transaction. Now the last point. Go through. Who you are here? Customer or supplier? We are supplier here because we build to the customer. We are supplier here. And what it is? FOB destination. So just we have to answer one question here. Like customer has received before year end or not? If not, it is our inventory. Has he received? No. It means it is our inventory. What is the value of inventory? 25,000. So we will add. So if you will add or plus minus these things like 5,000, 50,000 plus 24 plus 40 plus 25, this is going to be 139,000 value of the inventory. Clear? It requires just practice, Read 1-2 times carefully and do couple of questions, 2-3 questions. It will fix in your mind. Okay? Guys, I hope so you are listening me. So now we are talking about here what? Inventory estimation. One more point. Actually, we have to cover 2 more points, then class will be over. So inventory estimation, what it is? Actually, sometimes, maybe some inventory may have been what? Stolen, right? Or what? Destroyed by fire. So here what we are going to do, just we are going to calculate or we are going to estimate. I'm not saying actual. I'm saying we are going to estimate the inventory. By using which approach? That approach is called what? Gross profit margin approach. Actually, it's the name of ratio. Maybe in your study somewhere you studied these ratios, GP ratio, operating profit ratio, net profit ratio. What is GP ratio, guys? GP ratio, how you calculate GP ratio? You will always take what? Gross profit and you will divide with the sales. Gross profit divided by sales and multiply by 100. I'm sure you know what is gross profit. Gross profit is always equal to sale less cost of goods sold is equal to gross profit. If I will take GP and I will divide with the sales multiply by 100, this is what GP percentage. I'm asking one question. This all is just common sense. For example, we always assume sale is always equal to 100%, right? If cost of goods sold, let's assume, if in question he told you that cost of goods sold is 40%, assume, it means then gross profit is going to be 60%. Right or wrong? Understood? This is the one way. Other way is what? In question he might give you GP amount. For example, he might tell you GP is $1,000. You will take. Divide by sale value is what? For example, $10,000. And multiply by what? 100. It is going to be how much percentage? 10%. Now this GP percentage. Sale is always equal to what? 100. And GP is here, for example, how much? 10. So it means cost of goods sold is going to be balancing value, that is 90%. Right or wrong? You are clear with this, right? But point is, sorry, how to get the value of ending inventory by using GP percentage. It's not a rocket science. It's a very simple thing. So you know the normal equation. Normal equation. This is the normal equation I'm explaining here. For cost of goods sold, short equation, huh? Not the detail which we have discussed. Shortcut. For example, mostly we have opening inventory. We add what? Cost of production or purchases. This is called what? Cost of goods available for sale, or ignore this value, cost of goods available for sale if you don't want. Deduct what? Closing inventory. This is equal to what? Cost of goods sold. But we want to estimate which value. Do we want to estimate cost of goods sold or closing inventory? Closing inventory we want to estimate. And just I will reverse the equation. What I can do, I can take same opening inventory, same purchases, and instead of closing inventory, now I will deduct what? Cost of goods sold I will deduct. I will get what? Closing inventory. What I have done actually, just I will change the place. I will put closing inventory here and cost of goods sold. Right? Understood? So, and one more thing, cost of goods sold, if it is not given this value, because we need cost of goods sold in order to get the value for closing inventory. If cost of goods sold is not given, follow the shortcut way. This is the shortcut way. Shortcut. To get the cost of goods sold, how you can calculate? Cost of goods sold will be equal to, because this is what you are calculating. How? You will take value of sales multiply by what's written here, 100% minus GP percent. Actually what? 100% is the sale. If you will take 100%, it's a sale, minus GP percentage, automatically you will get cost of goods sold percentage. If you will multiply cost of goods percentage on with sales, automatically you will get what the value of cost of goods sold. Right or wrong? It's just a math, nothing else. Clear? Understood? And now this cost of goods sold, you will bring it here, this cost of goods sold, whatever value you will get, you will bring it here. Here. And the remaining, if you have opening plus purchases and you have a cost of goods sold, you will deduct cost of goods sold. Automatically, you will get what? Closing inventory. Is there any rocket science? No. It's quite simple. Just you need to work with this equation, and you must be aware with the cost of goods sold calculation. Clear? There is nothing other than this. This small example I'm showing on screen, you will just practice. Same format is applied here. That's it. Here you have beginning inventory, here you have purchases, it's given. And here you are estimating what? Here you are estimating cost of goods sold by applying the same equation which I told you. And this is your cost of goods sold. Right? If you will take beginning plus purchases less cost of goods sold, it will be equal to ending inventory. But just you will do this at home quickly. A simple question, nothing else. Let's have some exam kind of question. This could be there, like this type of question. For example, here we have the information about question. The following information applies to the income statement of a company. What we have here? We have here gross sales. Then we have a net sales. Gross means a total. Net means after deduction of returns. Then we got a freight in. Freight in means a transportation in cost. Supposed to incur on purchases. Then we have here ending inventory value you have. And then we have here what? Gross profit margin. And what is the question? You have to calculate cost of goods sold available for cost of goods available for sale. You are not calculating an ending inventory. You are calculating a cost of goods sold, a cost of goods available for sale. Clear? How you will do it now? I told you cost of goods available for sale. There are two things: opening inventory plus net purchases. Net purchases means the purchases plus freight in minus purchase return. This will be equal to cost of goods available for sale. Or you can do this way also. Cost of goods sold plus what? Closing inventory will be equal to cost of goods available for. Check, can you apply this? Do we have opening inventory data? Do we have opening inventory data in the question? Read? No. Do we have purchases data? I guess no. It means first way is not going to work. So then check this way can work or not. This way. Cost of goods sold plus closing inventory. Let's see. Cost of good closing inventory is given here. 200,000. One item we got. Only we need to get cost of goods sold now. Cost of goods sold for how you will get, he told you what? GP percentage. Do you remember cost of goods sold? How you will get, I told you cost of goods sold will be equal to value of sales. Don't take gross sales. Take net sales. Final value of sale. Right? Multiply by 100, which is sale, minus what? GP percentage. So sale value is how much? Net sale value is how much? 900,000 minus 100%. Sorry, times 100% minus what? GP is how much? 40. It means cost of goods sold is 60%. 60 times 900,000. It is going to give you cost of goods sold how much? 540,000. Now you will bring this 540 here. So you have 540,000 as the cost of goods sold. You have closing inventory, maybe 200,000, I guess. Check the question, right? So automatically cost of goods available for sale is going to be 740,000. Clear? Okay. I hope it is clear. Now, guys, one more point, topic which could be tested, obviously, your exam question, but theoretically. In terms of analysis, it can be tested. He will ask your analysis. Like there are errors in inventory. What might go wrong in financial statements or in the different components of the different parts of the financial statements. Okay. So I'm going to make it very easy. Just understand. First, we will discuss here in simple way, and then we will deal with bit complicated things. Inventory errors we are discussing now. And I'm starting again with simple format. Format for what? Cost of goods sold. And what is normal format? We have what? Opening inventory plus purchases. It's equal to cost of goods available for sale less what? Closing inventory is equal to cost of goods sold. And you can see in this equation, there are two types of inventory, right? Right or wrong? Which two types of inventory is there? Opening and closing. Which inventory you are adding to the cost of goods sold? Opening. Opening. And which inventory you deduct from the cost of goods sold? Closing or ending. Right? Okay, now what's the question? Let's start with the basic idea. For example, there could be an error either in opening inventory or in closing inventory. Error means to say in value of inventory which you have written is different than actual. And there could be two possibilities. One possibility is what? Inventory could be overstated. Overstated means to say you have written more than actual. Second possibility, it could be understated. Understated means you have written less than actual. Right or wrong? And how it is going to affect, so let's understand it. So guys, starting with first, with what? With the opening inventory. And then placing a line to make it more simple. If opening inventory is overstated, this arrow shows overstated. Overstated means you have written more than actual. So what will affect on cost of goods sold? Cost of goods sold will increase. Why? Because you are adding bigger value to the cost of goods sold. Right? Second scenario. If opening inventory is understated, cost of goods sold will also be understated because you are adding smaller value. Understood? Now I'm explaining here with the closing inventory. What will happen with the closing? This was with the opening. Effect on cost of goods sold. If your closing inventory is overstated, closing inventory you are deducting from the cost of goods sold. It means here you are going to deduct bigger value because it is overstated. Obviously, cost of goods sold will be understated. If your closing inventory is understated, it means you're going to deduct small value. So it is going to increase your cost of goods sold. So notice one thing here. What is one thing? Opening inventory is having direct relation with the cost of goods sold. When opening inventory goes up, cost of goods sold also goes up, and vice versa. And closing inventory is having inverse relation, indirect relation with the cost of goods sold. Understood? Clear? More closing inventory means say less cost of goods sold. Higher, lower cost closing inventory means say higher cost of goods sold. Understood? Ready? Now, one more thing. Now you know the effect on cost of goods sold. You know it. Now I'm asking another question. You know the cost of goods sold and profits always having inverse or direct relation. I'm asking you, inverse or direct relation? Inverse. More cost meant to say less profit. Less cost meant to say more profit. Right or wrong? Understood? It means we can now see the effect of inventory over the cost of goods sold, from cost of goods sold to the profits also. Right or wrong? So here we go. It's written in table shape here. Here we are dealing with first. I'm going to say this scenario I'm going to cover. If opening inventory is what? Overstated, and said this. So cost of goods sold is also overstated. Right? If opening inventory is understated, closing inventory is also, or cost of goods sold is also understated. Right? Now can you link the closing inventory? If closing inventory, this is closing. If it is what? Overstated, cost of goods sold is going to be understated. See, over and under. If it is understated, this is going to be overstated. Now forget about everything and focus on cost of goods sold. Cost of goods sold and profit always have inverse relation. If cost is over here, obviously profit will be understated. If profit is if cost is understated, profit would be overstated. Opposite just, right? And if it is here, because when closing inventory was overstated, cost of goods sold was understated. If it is understated, profit is going to be overstated, right? Here, if it is cost of goods sold is overstated, profit is going to be understated. Here you can create the link, right? Thus you have to think effect on cost of goods sold, and then from there you can move to the profit. It will be more easy. Otherwise, I can create direct link with the profit also. Opening inventory always have inverse relation with the profit. You can see over, under, over. And closing inventory have direct relation with the profit. You can see over, under. Right? But it's better conceptually you should think. Link with first cost of goods sold. From there to onward, you should move to the profits. Their concept will be clear, you know. Okay. Then I'm linking this profit with what? With the retained earnings. You know, the same profits from the income statement. You will transfer to the retained earning under the statement of changes in equity. If you don't remember this name, no worry. But this profit will be transferred to the retained earnings, retained profits. And obviously, if your profit is understated, so retained earnings should also be understated. Agreed or not? If your profit is overstated, retained earnings should also be overstated. If your profit here is overstated, it should be overstated also. If profit is understated, retained earnings should also be understated. Clear? But this will happen in only one specific year. Understood? Now I'm going to check the effect of error, especially in the closing inventory, over the 2 years, what will happen? This was the effect of error in one specific year. If in question it told you 2 years information, but he's asking over 2 years, then how it is going to affect? I'm going to explain. Clear? Over the 2 years. Can I create simple link? Otherwise, it's written in the sheet. You can just browse. But here we go. This because short summary is more fruitful. Right? So I'm placing years first. Let's assume this is my year 1. And here I will place year 2. Okay? And obviously, over the 2 years, we are going to check effect of error in closing inventory of the first year. How it will affect the profits and other things over the second year. Right? Why over 2 years? Because this closing inventory will become opening in the next. But if there is a mistake in the opening inventory, it is not going to be affect the next year. So that is just we are talking about which inventory. Here I'm putting word here, column, I'm making column closing inventory. Effect of closing inventory over first we will check the cost of goods sold in specific period. Then we'll see over the profit, and then we will see over the retained earning in the specific period. And then we will move to the second year. So there is scenario number 2. If closing inventory is what? Overstated. Remember the normal rule. Cost of goods sold will be understated. We discussed this previously. If cost is understated, profit will be overstated. And retained earning will be overstated too. Clear? Now this closing inventory will become opening inventory next year. Right? Again, we have the same column. Cost of goods sold, profit, and retained earning. Ready? If closing inventory was overstated, obviously next year what will happen? Opening inventory will be overstated, right? Right? It will be overstated. Now think what will happen next year. Next year, if opening inventory, now think about year 2. If opening inventory is overstated, cost of goods sold will be overstated also. Right? Because opening inventory you have to add the cost of goods sold. And profit will be understated. If profit is understated, what happened? Retained earning is understated. But look, with the same value, last year retained earning was what? Overstated. And this year, retained earning is understated with the same value. Over the 2 years, retained earning will be unaffected. Will not be affected. Because with the same value, it was overstated in the first year. And with the same value, it is going to be understated in the next year. So one time you added, and one time you have deducted same value. So it means over the 2 years, retained earning is going to be what? Unaffected. Clear? He will ask the question. He will tell you opening closing inventory in the 1 year is overstated or understated. What will be the effect on the retained earning in next year? Okay? You have to see. But if I'm changing my question now, I'm saying my closing inventory is overstated. What is the effect on retained earning in year 1? In year 1, look at the screen. It is what? Overstated. This is my answer. But if I'm saying my closing inventory is overstated in first year, what will be the effect on the retained earning in second year? I would say it will be unaffected. Over the 2 years, it will be unaffected. Because here I'm talking about over 2 years, not for a specific year. Clear? Scenario number 2. Let's create now other way around. If closing inventory is understated in year 1, obviously cost of goods sold will be over or under. It will be overstated. If cost of goods sold overstated, profit is understated, and retained earning will also be totally opposite sign, right? Sign will totally opposite now. And this is going to be your opening inventory next year. It is going to also be understated now. If it is opening inventory is understated, cost of goods sold will be no understated. Opening inventory is understated, right? I also am drawing correct arrow, right? If opening inventory is understated, cost of goods sold will also be understated. If cost is understated, profit will be overstated. If profit is overstated, retained earning will be, and look what happened here. Retained earning was understated. Retained earning is overstated. So over the 2 years again, it will be unaffected. Clear?
I have multiplied mistake in 1 year. In the closing account, in the closing inventory, what's the
Sorry, can you repeat again?
I have multiplied mistake in the opening inventory and the closing inventory in 1 year. How would be
I didn't get the question. Can you?
in 1 year?
1 year.
You have two mistake, two multiplied mistake in the.
So each mistake you have to correct independently, you know. Each mistake then you have to correct independently. Obviously, you cannot take net because the accounting record should also be correct, you know. You have to correct on the back end.
Take the net amount.
No. Net amount you can do just to solve the question. But practically you need to adjust both values in your ledgers also. To solve the question, yes, you are right. You can take the net amount. If there is a mistake in opening inventory and closing inventory both, then see the net effect and adjust. But to solve questions. For practical work, no. You have to adjust the ledgers, relevant ledgers. Right? To solve question, you are right. You can take net. Clear, guys? So this is what is it was topic. Please, you have to just go through first this topic. This information is more than enough in order to tackle the questions. So what will happen if you will open the questions from software? First, you have to familiarize yourself. First 3-4 questions will give you a bit tough time. It doesn't mean it is out of the thing which we have discussed. No. Actually, your tone will be set for the question. In the first 2-3 questions. Once your tone will be set, automatically then it will start repetition of the things. Right? So this, what is your homework? You have to study topic from, it's included in the notes, even notes are better, whatever I'm showing here. So you can read from your book also, but your duty is to solve the question from software, topic number 2.2 for the inventory. Okay, it's unit 2, because for our first unit, you can get the recordings I'm talking about you guys, as it were appearing. If you want to get recordings, you can get recordings. Okay, but you will do the question for topic number 2.2 first. And before moving to the question, please repeat the topic first and then start doing the questions. And if you will do on the same day or 1 day after, it's good for you. If you will start doing after 6 days, you will forget what you learned, right? And this is the problem with the working people here. So thank you so much, guys. See you in the next class. If you have any question, you can ask me.